All right. What's up, guys? Hope you're doing well. James here from jamesdforsythe.com. And I wanted to take a minute to go over the interactive tool that the Federal Reserve Bank of New York has basically brought out. It was actually published in, let me get to the right tab, sorry. But it was published in 2015, basically about the repo market and trying to make it more kind of transparent in a way. So, with that being said, head over to screen share the post. And basically, they title it the tri-party repo market like you've never seen it before. And it's basically just an interactive tool to where you can look at the various kind of mode. It's like the Fred chart, so you can see from the Federal Reserve Bank of St. Louis for kind of general macro data and a bunch of other things. But this one is done by the New York Fed and is basically just for the tri-party repo market, right? And I'll actually go over to the tool in a second to where you can see it. But this entire post is basically just kind of plugging this tool in a way and talking about how it is. So, just some kind of general facts of the repo market in general. So, since March of 2010, in accordance with Recommendation 13 of the Task Force on Tri-Party Repo Infrastructure Reform Report, I don't know what it is with. It seems like task force is like the favorite term for any form of kind of public entity. Like they just love task forces. They need a task force for everything, right? Which I don't know. It's just something I've noticed, and I think it's kind of funny because it almost seems like something you'd hear in like a high school almost, or like I guess pretty much just in academia is where I pretty much always heard that. It may just be anecdotal, but anyways, it's a bit off topic. But anyways, so the Federal Reserve Bank of New York has made monthly data on the tri-party repo market available to the public, right? Trying to increase the amount of transparency in that in general, because kind of shadow banking and the repo market beforehand has been kind of a, I guess, shadow in the shadows is a great way to say it, meaning that it's hard to get data on, right? And a lot of it's just not taken care of or not tracked, I guess I should say. And that's quite different with tri-party repo because you have that kind of clearinghouse in a way, or that central kind of mediator, whereas you don't have this with bilateral repo and that sort of thing. So what you see is that in the market as a whole has fluctuated between 1.5 and 2 trillion, and the riskier assets represent less than 500 billion, right? And this is talking about the tri-party repo market in general, right? In terms of general magnitude. And so another view reveals that the share of riskier assets have been around 20%, but has increased in recent months. It was as low as 14.5% in June of 2012 and as high as 23.5% in May of 2015. Right. And so these are just kind of stats they're rambling off with respect to the actual interactive tool itself, things that you can find when you play around with it. So here's kind of a screenshot that they have of the tool itself. You can see this is with volume and you can put dollars, percents, a whole bunch of other different assets. And we'll actually go over to the tool in a minute so you can kind of see it better. So the amount of non-investment grade corporate bonds has been stable, as you can see in the tool. So in contrast, the amount of equities financed in the market has increased a lot since early 2012. And so that's one thing that basically this tool can be used for, is really seeing the different types of assets that are used, right? And that being said, so you can they also go into like haircuts and stuff. So the actual haircut of said repos, right? And if you don't remember what a haircut is, it's kind of like it reminds me a lot of discounting. Like when you buy treasury bills, you get basically paid interest on a discount method in a way to where you don't say you're buying $1,000 worth of treasury bills or whatever, say 4 week, whatever it may be, and you don't actually pay $1,000. So you pay basically whatever the annualized interest is, right? Divided by 12 for the 4 week bill in that example, whatever the maturity is, basically annualized returns, right? And then you pay whatever the $1,000 is minus that discount, right? And so, like, say it's 2% interest on a 4 week bill. We'll just say it's like, okay, you pay $998 or so, somewhere in there, right, for the 4 week bill. And then at the end of that 4 weeks, when the bill matures, you get $1,000 back, right? And so, with that being said, you have that's what kind of haircuts remind me of. It's kind of like whenever the borrower, no, I'm sorry, the lender, whenever the lender is basically pricing in a sort of interest on said loan or on said repurchase agreement, I should say. They're basically like, okay, this is the collateral they're giving me. How much do I think it's worth based on the risks that I see, right? And based upon how much I can see this fluctuating within the given span of whatever the contract is. Because, I mean, typically these are overnight, if I remember correctly. The vast majority of them are overnight, but they do have some form of, there's other ones as well to where the maturity can change, right? Um, that sort of thing. And so that's kind of what a haircut is. And so you can see the median haircuts. And according to the tool, they've been very stable for most asset classes because you can break this up in assets, different asset classes, I should say. So there are a few exceptions, mainly those asset classes for which the dollar volume is very small, like collateralized debt obligations, so CDOs. The median haircut for CDOs was 5% early in the sample, but was as high as 15% in June of 2015, right? So the 90 percentile for that asset class has increased from 8% to 25%, right? And so you can even break it up into percentiles and a bunch of other things, right? They also bring it into concentrations. So basically, the more concentrated a collateral or a specific form of collateral is, um, in terms of dealers, right? So if one large dealer has the majority of a certain type of collateral, then basically the risk of fire sales, as they put, is a lot higher since the market is more concentrated, right? And so they say concentration has decreased for most asset classes, which should reduce the risk of fire sales to some extent. And so that said, there are large differences in concentration among the different asset classes, right? So an example they give is with mortgage-backed securities, which has decreased from close to 50% early in the sample to less than 30% recently. And then concentration in equities has decreased overall, um, and but has been rising since late 2012, right? Keep in mind this was posted like 7 years ago or so. So that being said, let's head over to this interactive tool. If I can find the hyperlink. And let's see, I need to switch. I'll stop sharing. See if it'll load. Right. Okay. Sorry for the technical difficulties. For some reason, I didn't want to switch over directly. Normally, you have like you can tell it how to switch tabs. So here's this. All right. So this is basically an overview, bunch of words, but here are the tabs I was talking about. So you can change with volume, dollars and percentage terms, right? So general volume changes via percentage. I guess you could say on the left here, you can see the different types of asset classes, and they actually break it up in between Fedwire eligible and non-Fedwire eligible, um, that sort of thing. And so you can literally just play around with this. Like you can add like money market funds, we'll go equities, junk bonds, that sort of thing, and it'll graph the lines and that sort of thing. And you could uncheck things, change the colors. Like all the other Fred charts, you can change the scaling of the years. So, like how I just changed it to ending in 2020. So, September 2010 to mid 2020 or so is what I changed it to now. Like, you can pretty much do whatever you want. You can change margins, you can see the ranges. Like, it's literally like you can go in here and just play with things. Look at the different concentration of the asset classes, right? That like it's literally like that. There's GCF repo, like really like it's that interactive. Tri-party slash GCF. Like you can fully play around with this thing, right? And so with that being said, I highly recommend looking at it because I think it's pretty interesting. And so basically, I mean that's what I plan on doing. It's pretty much just playing around with it, trying to get more familiar with that sort of thing, probably even use some of the charts. I'm assuming like you can actually export the charts, and just like you can with the Fred charts from the Federal Reserve Bank of St. Louis. Um, Looks like they have a downloads tab. Yeah, where you can do export it as a data sheet, things like that. Yeah. I kind of just wanted to share it, kind of looking into a general overview of repo in general. in this case, tri-party repo. So yeah, with that being said, I'll probably go more in depth with certain aspects of the repo market as I kind of learn more and want to share and that sort of thing. And so, yeah, we're just going to leave that one here. So I hope you guys have a good night, and I will see you on the next one.